Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is increasing his threats against Iran. In a post on Truth Social, Trump warned that Iran's civilization will die tonight unless the country strikes a deal in what he called one of the most important moments in the history of the world. Trump is also demanding that Tehran reopen the Strait of Hormuz. The latest threat comes after U.S. forces struck military targets on Iran's main oil export terminal, Karg Island. Trump has set a deadline for a deal to be reached of 8 p.m. Eastern tonight. Home prices in Canada's largest city fell to their lowest level in more than 5 years. Data from the Toronto Regional Real Estate Board shows the benchmark price of a home in Toronto dropped 0.6% in March compared to the month before, the lowest since December 2020. Meanwhile, the supply of listings remained elevated. On the upside, the number of homes being sold in March increased for the first time in 6 months. Shares of Pembina Pipeline are edging higher. The oil and gas company expects to deliver up to 7% profit growth through 2030. Pembina will be supported by annual fees, higher utilization of existing assets, and contributions from new projects. The Calgary-based firm says its long-term growth plans include investments in LNG, liquefied petroleum gas, and emissions reduction infrastructure. And taking a look at the markets right now, down day across the board. TSX off by about 0.3%. Tech taking a big hit, off by more than 2 right now. On the plus side, the energy index, we're looking at about a 1.2% increase for the day so far. South of the border, again, all the uncertainty. Oil up and markets are down. Another big hit. S&P 500 off by nearly a point. Dow Jones by 0.75%. And the Nasdaq is off by 1.5 points. While markets are down today as investors worry about the conflict in the Middle East and it's intensifying ahead of U.S. President Donald Trump's deadline for Iran to agree to a ceasefire deal. Here to tell us how he's been navigating this unstable period is Josh Salick, the CIO and portfolio manager at Verican Capital Management. Josh, thanks very much for joining us. This is quite the course that people are trying to navigate. The Strait of Hormuz almost looks easier. How are you handling everything that's unfolding on such a day-to-day basis?
Trying to ignore it as best as possible. Honestly, it's one of those things where the day-to-day rhetoric is really driving the markets on a day-to-day basis. And unless you can predict that, and I don't think anyone can, just strategic ignoring, I guess we can call it, is the best approach right now.
Okay, so what are some of the things that you're ignoring and what are some of the things you're paying attention to?
Yeah, anything more related is something that not ignoring. It's definitely important, definitely to stay on top of it, but it's not really relevant for decision making due to the unpredictability of it all. What we're trying to do is look through the war-related headlines and look at what are the real economic impacts of this going to be. We seem to have forgot tariffs and AI-related content for the last month, which is kind of interesting because that's probably A, far more meaningful, and B, has a lot more staying power.
I was going to ask, of the three, which is the one that really people should be looking at and see what's unfolding? Because those two have really taken a background, especially the tariffs.
Yeah, I think the AI story still has a lot of legs. That's going to play out over many more months, many more years, perhaps many more decades. So that's something that has some real staying power and is going to have real economic impacts on a lasting basis for not only economies, but also individual companies as well. The tariffs, that's just kind of like the war, maybe a little bit on the back burner now, but very unpredictable as well. So that's something that, again, unless you're in Trump's inner circle, you probably don't know exactly what's going to happen with either the war in Iran or with tariffs. So best to stay out of that type of game entirely when it comes to your investment decisions.
All right. And with this on the side here is bonds. Bonds have kind of, it feels like they're a little bit lost right now.
Yeah, they have been. Also taking a hit due to the inflationary pressures that you feel through higher oil prices over the last month or so. But I think what we're with the higher interest rates, what we're kind of forgetting is that at some point, higher energy prices are not going to be inflationary any longer. They're going to be disinflationary or deflationary as people have less money to spend on the things that really matter to them because they're spending all their money filling up at the pumps. So if you have a bit more of a medium to longer term outlook, you can actually look at high interest rates as maybe being advantageous at the moment, because if you see some economic cracks start to form, then bonds are still going to be the trusted source for stability that people will flock to. And you should see at some point down the road, if again, we're expecting at some point perhaps the economic cracks start to form, interest rates probably come down in that type of scenario. So although investors have seemingly gone away from long-term bonds, and you can see that through higher yields over the past month or so, it's not something to be totally ignored, especially if you're looking for a little bit of stability in your portfolio.
Okay, and with that portfolio, what is something investors should be looking at, and then something on the other side, something people should be looking at, shying away from?
Yeah, well, when we were prepping for the show, I took a bit of a cheeky approach to this and said that one thing in your portfolio that you want to maintain some exposure to is the energy and materials sectors at the moment, for obvious reasons. But especially over the past couple of years, you can see that these have continued to act as sort of a hedge for markets. But I also said that at the same time, you don't want to have too much exposure to these sectors because they do tend to be more cyclical, more volatile, and lower quality than the market at large. So what we've seen over the past couple of years, as the Canadian market has really rallied on the back of oil and precious metals, is that energy and materials now make up about 40%. Those two sectors make up about 40% of the TSX composite. Mm-hmm. That's really high for those two sectors. Globally, it's a lot less, in the 5 to 10% range for those two sectors combined. So we tend to be on the equity side of our portfolio about 10% exposed to those energy and material sectors, which we think is a reasonable amount of exposure to have to those. So depending on where you lie, are you more Canadian focused, or are you more globally focused? It's definitely something you want to pay attention to at the moment, especially with energy prices at very high levels and precious metals prices at very high levels too.
And now with that 10% in energy, the other 90, I guess, is elsewhere. If you're all in the Canadian market, is it difficult to find, to spread that money out in places that look appealing?
Yeah, absolutely. And that's why you probably shouldn't be 100% in the Canadian market. If you're an equity investor, you want to look internationally. You want to look to the U.S. Despite a lot of the rhetoric that surrounds the U.S. and the loss of exceptionalism, as we've called it, the highest quality and most diverse and most dynamic companies still reside in the U.S. and then to a lesser extent internationally as well. So if you're an equity investor, you should not be just focused on Canada. In fact, you should probably have more of your portfolio outside of Canada than inside of Canada, because you get far more diversity and far more dynamic and profitable and quality companies outside of Canada.
And what are some of the things you're staying away from right now?
Well, we tend to not be an investor in gold at all times. It's not anything about specifically right now. We just find gold to be what I would call an impossible asset to value. If you can't put a value on it as fundamental investors, it's not going to be that interesting for us. And we continue to stay away from some things that we've stayed away from for a long time. That's something like cryptocurrency or highly speculative assets. Those just never have really found a place in our portfolio at any time. It's not just a right now thing.
All right, and I think we got to wrap it up there, but I appreciate you joining us today, Josh. Thanks very much.
Thanks, you.
Josh Shellick is CIO and Portfolio Manager at Verican Capital Management. Coming up, are we looking at $200 oil if Trump follows through on his threat on Iran if a deal isn't made by 8 p.m. tonight? We'll talk about that more after the break. U.S. President Donald Trump threatened to wipe out Iran if it doesn't make a deal by 8 p.m. tonight, as top Democrat and Senate Minority Leader Chuck Schumer called him an extremely sick person. With oil prices on the cusp of exploding, is Canada in a position to benefit? Let's break it down with Clay Seigel, Senior Fellow at the Energy Security and Climate Change Program, Center for Strategic and International Studies. Clay, thank you very much for joining us.
You bet. Good to be with you.
How do you see, or can we even see how today might unfold with that deadline of 8 p.m. tonight?
Well, it's a pretty stark threat that's been issued here. I think that the brinksmanship is certainly at an all-time high since this war started in late February. But the stakes are really high for the energy market in particular, and from that, the global economy. Because if we have a sustained period of very high oil prices, that's going to proliferate through other parts of the macroeconomy. You know, consumers are going to have to pay more, and they're going to be less likely to spend on other stuff. Businesses are going to have to pay more to move goods from factory and port to market and to people's doorstep for substantially everything that households buy. So we're going to see higher prices proliferate through the economy, and that could result in an economic slowdown, GDP coming in lower than forecasted before the war, and potentially even a rise in general price inflation. But in the energy market in particular, we have to be concerned about demand destruction, or at least demand curtailment. And so even for oil producers that tend to do better along with somewhat higher prices, you can have too much of a good thing. And we've seen in past oil price spike episodes that prices got so high that consumers and businesses pulled back on demand. And that's not good for oil companies either. They prefer a steady state of sustainable prices for the medium and long term.
It's kind of not bad for the environment and other things. I mean, there could be some positives when it comes to that. How, with these soaring prices, are we talking recession if it continues? If this deadline comes and the end of the world is launched on Iran, as Trump was threatening, will that lead to a recession if this war drags on?
The end of the world, as you put it, does sound bearish for financials generally. But I would say away from today's tactical deadline, and who knows what's going to be in effect by this time tomorrow, the bigger picture here that companies need to plan for is medium-term instability for energy exports from the Gulf. We were receiving about 15 million barrels per day to world markets of crude oil from the Mideast Gulf before the war, and that's down to just about 6 million barrels per day. So we've lost 9, we've lost 60% of what was coming before. And the world oil market can't live, at least at the same size as before, without that flow of oil from the Gulf. And gas is important too. So 10 billion cubic feet of liquefied natural gas, primarily from Qatar, some of which is going to be offline, apparently, according to Qatar Energy, for a period of years. Where I'm going with all this is the world market needs that supply from the Gulf. There's no way that supply side adjustments can compensate for that size outage. And so the only coping mechanism for the market is to shrink if we have sustained high oil prices. And that's going to mean a downturn in demand. And that's what translates to the lower GDP that I was alluding to before.
And now we're seeing it, of course, in Asia. They're having to pull back. They're rationing. Europe could be next. Could that come to North America? I know we're considered an oil country in Canada and an oil exporter in the U.S. Could it come to us, though, as well? Could it hit us?
Yeah, certainly it will hit us in some capacity. It's true that here in North America, we are somewhat indemnified from the global effects because, of course, we are long crude oil. And in the case of the United States, at least, refined products. We're exporters to the world. But it's a global commodity and a largely fungible commodity. And that means that a disruption anywhere affects prices everywhere. And you've already seen headlines as recently as this morning that North American crude oil prices are starting to get pulled higher, even though there's no sign of a physical shortage in this part of the world yet. That's just simple global arbitrage. When you start to get higher prices in Asia, that's going to pull more crude oil from west, like in the Atlantic Basin, toward those east of Suez markets. This is how efficient markets function, and we're seeing it again in the case of this disruption. This
adjustment, how can you see Canada benefiting from this, or will they?
Well, when we talk about benefit, you have to think about the time horizon. And the way these price spikes have gone in the past is, of course, higher oil prices, which is the product that producers sell, can be beneficial for earnings in the short term. But if the secondary effect is for a pullback in demand and potentially even permanent demand destruction in some cases. And I think you alluded to the environment and maybe potentially the sale of additional electric vehicles. And in other words, some segment of the transportation industry retiring conventional engines and switching to renewables, that has the potential for longer term effects to have lower prices. We have to see how all this shakes out for regional balances before we can really call prices, though.
And could this drive the electric vehicle market? I mean, we've seen the rebates and everything disappear in a lot of places, but the 73 oil shock drove a lot of people towards smaller cars. Could this be a tipping point for electric vehicles as well?
Yeah, I think it's definitely possible. If you run something like 6 to 12 months of really elevated gasoline prices, I do think that that's constructive for the EV sales trajectory. But longer term, when we talk about effects on the environment, I mean, you can say that it all adds up, and I think that that's true, even on an incremental basis. But you got to remember, it takes many, many years, even more than a decade, to put a significant dent in the stock, the composition of the vehicle fleet that's out on the road. And so even if you had a change in new sale patterns over a period of 6, 12 months, that's probably not enough uptake into the stock of the total fleet that's out there on the roads to really make that big of a difference, moving the needle for greenhouse gas emissions and environmental consequences.
Okay, Clay, we have to wrap it up there, but thank you very much for joining us.
Thanks for having me.
Clay Seigel is Senior Fellow at the Energy, Security, and Climate Change Program, Center for Strategic and International Studies. Coming up, today's market drivers with Bloomberg's Monique Malima, including Pembina. Time to take a look at today's market movers, and we are joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us.
Thanks for having me.
Okay, let's talk Pembina right now. What's going on with them?
Yes, so Pembina, their shares are rising this morning after the company gave their adjusted earnings outlook for through 2030. The company is projecting that they're going to see growth between 5 and 7%, and analysts are really positive on this outlook. They say it is higher than what was previously expected, and they also note that it puts the company more in line with some of its peers and the growth that they've been seeing. And they say that this is something that investors had really been looking for. They wanted to see the company be able to accelerate their growth. Pembina also gave an outlook for some of its hedging and said that currently about 65% of its frac spreads are hedged. And this is something that analysts also see as positive, with all of these combined really helping to lift the shares today.
All right. Nutrien, I guess war is good for business.
Yes, so Nutrien, their shares are higher today, and RBC also raised their price target on the fertilizer company. A lot of fertilizer and the inputs for fertilizer come out of the Middle East and are being disrupted by the war and the closures of the Strait of Hormuz. So as a result, the North American producers like Nutrien have been seeing more demand and also have been seeing their prices rise. So analysts say that Nutrien is going to be able to benefit from the higher nitrogen prices, that this will help increase their free cash flow for this year and maybe even into early next year. And they also note for the potash market that it's been remaining steady and is also seeing market demand remain steady. So for the different aspects of their business to all be seeing benefits from this, that's really helping their shares.
Okay, and Barrick's having a bit of a rough go in Pakistan right now.
Yes, so Barrick announced yesterday that their Reko-Dik project in Pakistan is going to be slowing their development, potentially suspended. And this is a project that's faced a number of security concerns. The project is near the borders with Iran and with Afghanistan. So right now it is facing a number of difficulties. And analysts say that this doesn't come as a surprise. This project had been known to have ongoing security concerns. And they think that maybe potentially the company might have to look at either ending the project altogether, maybe selling the project to other producers. But they actually see this pause as a positive step because they think that now the company can focus more of its efforts on projects that are producing right now that have less concerns. But some analysts, like at ATB, did lower their price targets on Barrick, saying that the company then won't see the cash flow from this project due to the suspension.
And does Barrick have any other projects in Pakistan that might be impacted like this one?
This one is the main one of concern just because of its location. Obviously, right now with the Iran war, being near the border of Iran is not the most positive position to be in. So this is kind of the main thing of concern. And Barrick right now is also focused on exploring a potential IPO of its North American assets. So analysts kind of expect that that's where the company's focus is now going to be, looking at those North American assets and towards potentially taking them public separately.
Okay, Monique, thanks as always.
Thanks.
Bloomberg's Monique Molima. Up next, we take a look at U.S. markets as tensions in the Middle East continue to escalate. March home prices in Toronto fell to their lowest level in more than 5 years, according to data from the Toronto Regional Real Estate Board. The benchmark price of a home in Canada's largest city dropped 0.6% from the previous month, and the lowest since December 2020. Home prices declined and the supply of listings remained elevated. However, Toronto home sales in March increased for the first time in 6 months. Shares of Broadcom are moving higher. They're up about 3% after the chipmaker announced a long-term agreement with Google. The deal will see both companies develop and supply tensor processing units, offering an alternative to technology from NVIDIA. The company also confirmed plans to work with Anthropic to power the IT operations under those terms. Anthropic will get access to about 3.5 gigawatts of computing capacity. Shares of health insurers like United Health Group, Humana, and CVS are getting a boost. This comes after the U.S. government announced it will pay private insurers close to 2.5% more in 2027. According to the Centers for Medicare and Medicaid Services, the policy is expected to add more than $13 billion U.S. in additional payments to Medicare Advantage plans next year. And looking at the markets right now, they're kind of clawing their way back from the start this morning. TSX off by about a quarter point, but we'll see what happens by the end of the day. And the U.S. markets, they are struggling, trying to find some direction. Of course, concerns over what may happen in the Middle East fueling this right now after the rally of last week. S&P 500 off by 0.84, Dow Jones by 0.75 points, and the Nasdaq is off by about 1.25. Okay, volatility has been the name of the game for several weeks now. My next guest, though, believes the U.S. stock market will not see a prolonged weakness in 2026. Let's bring in Brian Balsky, CEO and CIO at Cumulus Investment Strategies. And Brian, thanks very much for joining us.
Thanks so much for having us. Good morning, Canada. It's cold here today. Cold.
This is warm with what we've had through the winter. Okay, you look like you're coming from somewhere sunny. I'm jealous.
Well, you know, it's a tough life having a company based in Florida, but we'll get by. We'll get by.
Okay, what gives you the sunny optimism right now with how things are unfolding?
Well, we believe in fundamentals, and we continue to believe that the United States stock market is the highest quality stock market in the world. Followed by Canada, by the way. Canada obviously had a great year last year, something that we called for a few years ago for Canada to outperform, and nobody really believed us. Now Canada did that. We think it's probably time to lighten up on some Canadian positions and really focus on the U.S., given its more diversified nature of its index, number one. Number two, let's just talk about what's happened the last 4 to 6 weeks. The U.S. markets have outperformed the majority of global markets. Gold has underperformed. And I think that actually tells you a lot about the consistency and quality of U.S. equities. And that's why our theme of a 25-year secular bull market for U.S. stocks that we first came out with in 2009 continues to be very much in place.
So we're 2/3 of the way into it of this bull market, you think?
Yeah, I think we have at least another 8 to 10 years. I think some of this quote-unquote silliness of the last 2 years actually adds a couple more years. So here's why. Last year, obviously, we had the tariff and the Liberation Day malaise. This year, we have the malaise with respect to the conflict in the Middle East. Now someone's going to dial in and say, well, every year there's a malaise. Well, not really. We do believe that we will head toward more of a normalized type earnings-driven market, which is our call for 2026 as investors focus more on fundamentals and less on momentum. If you take a look at where the market has been performing, it's really starting to delineate the winners from the losers versus last year. Everything was all kind of going up together. And that's one of those markets where driven by momentum can't last very long. And that's why we are very, very confident in the fundamental natures of U.S. stocks right here.
Okay, and I know with the war, you want people to stay calm and be smart about things. When does it become a real issue or a real concern for the markets to have an impact on it? It seems like they've kind of started to factor it in, but when does it become a factor? Is it oil at 150?
It's a great question. I don't know if they factored in, because if you take a look at last week's rally in markets, and now this week we're really focused on, at least today, with this quote-unquote deadline here tonight from President Trump. But I think to use a bond term, not a stock term, I think this is a duration game. We start to see demand destruction, quite frankly, if we see $100 oil for 3 to 6 months, not 3 to 6 weeks. Given the fact the United States of America is the world's largest producer of oil, we're going to continue to pump that out, number one. Number two, with respect to what we've seen in terms of inflation and how inflation can go up like an elevator but down like an escalator, near term, I think that's a bit of a concern. But we've already seen investors move into more higher quality areas anyway. So I think this is a duration game, and it's not just a 3 to 6 week game.
And how does this compare? How have previous shocks, geopolitical tensions, how does this one compare, and how did they do? How long did it take to recover from them?
I go back to 1990. This young kid was in the business back then. And I remember my boss at the time, in August of 1990, pulled the entire firm together on the same floor and said, we're heading into recession. We got to cut costs. What did that mean? Half the research department was gone the next day. And then, if you remember, that was when Iraq invaded Kuwait. The U.S. did go into a consumer recession. It lasted exactly a quarter, not 2 quarters, but a quarter. By the end of 1990, we were fully staffed up in research again, and the resumption of the big 82 to 2000 bull market started to go again in terms of momentum and consumer stocks and some tech stocks. So this could end very quickly, and we do anticipate it's not different this time. Once we get this all clear and start feeling better about the news flow and people start to have a little bit more confidence, we believe the stock market's going to rocket.
Okay, but you're saying also, though, in your notes that there's some investor sentiment that it's bearish, and you're calling that a good thing.
Yeah, well, people may think I'm always positive momentum person, but at the end of the day, I'm a contrarian. And we always want to go to where the puck is going. If everyone is negative now and everyone's talking about how terrible things are, we want to be positive and understand that stocks are led by fundamentals. And again, let's go back to the very first thing I said. The fundamental construct of the United States stock market in terms of earnings, valuation, operating performance, the consistency of technical performance, I think, sets it apart from other areas. So we're going to be positive. We're not going to focus on emotion. Remember, last year, I came out with a report saying we're not changing anything in our portfolios. We're not going to react to what's happening. And a lot of investors left the United States, and they missed out on an amazing opportunity to own stocks from that April to the end of the year rally. And we're not going to be led by emotion. We're going to be led by fundamentals.
All right, but you're still not ruling out a correction. Excuse me, a correction, though, possibly in 26.
Yeah, I mean, if in earnings-driven markets, they actually are more volatile than fundamentally valuation momentum-driven markets. So when we talked about 2026, we cautioned investors that we are going to have these drawdowns, we are going to have these corrections, we are going to have these moments of doubt, but these moments of doubt and corrections provide opportunities from a longer-term perspective. You should not be selling when everyone's negative. You should be actually looking at your portfolio and figuring out how much dividend growth do I want to own, how much value do I want to own, how much small mid-cap do I want to own, and what does my tech stock component look like for the next 12 to 18 months minimum.
All right, we have to wrap it up there, Brian, but thanks very much for joining us. And do us a favor, take this snow back with you to Florida, please.
I'm going to try, but I will tell you, man, I've got my gloves on. I'm walking around downtown. I am cold.
All right. Cheers, Brian. Brian Belsky, CEO and CIO at Cumulus Investment Strategies. Up next, jet fuel surcharges are driving up the price of airfare. We discuss how your travel plans might get hit after the break. Well, the energy crisis has significantly impacted fuel prices, leading airlines to impose surcharges and take other measures to tackle the high costs. Here to unpack it all is Robert Kokonis, President and Managing Director of AirTrav. Robert, thank you very much for joining us.
You're welcome.
We're starting to see it now, the surcharges. Is there, how bad is it going to get, do you think, and for how long? I guess it depends on what happens, right?
No end in sight. Just a reminder for viewers and listeners that domestically and transborder, our carriers got rid of surcharges back in September of 2008 as the global financial crisis started to see oil prices back off rapidly. But we kept international surcharges. But airlines can increase prices either through a surcharge or through base fares, and internationally they can do either. And I predict that if this insanity keeps up, we could see the reintroduction of domestic and transborder fuel surcharges. But with the prices we're looking at right now, anything's on the table.
And there's really, and nobody wins with this. The airlines take a hit too because they have fewer people traveling, don't they?
Yeah, as my economist calls it, it's demand destruction. You have demand destruction. You can only raise prices so far, then people stop traveling or slow down what they can afford to travel, already in an economy that's been taking hits from trade and tariff battles. But you also have the danger in some national economies of jet fuel rationing and shortages. And that alone, we're seeing airlines around the world suspending flights for April and for May. Lufthansa of Germany, Lufthansa Group, stated they were going to ground 20 aircraft initially and up to an additional 20 already. So demand destruction, less people traveling and airplanes on the ground.
And now, and we've heard, last I heard, there was one last shipment of jet fuel going into the UK, and then they didn't have any more coming in for the next month.
So we call it cargoes on the water, ocean-bound cargoes. The last of the cargoes globally would be delivered between the 10th and the 15th of April. UK is particularly problematic, given that they've usually got about five or 6 weeks of inventory, and that's not a lot. Poland, a much smaller aviation market, they're even less. And then, of course, you get into Asia Pacific. I mean, countries like New Zealand, they import 100% of their jet fuel distillate. Australia, 90%. So we're going to start to see some countries starting to ration, if you want to put it that way. There's scarce stocks of jet fuel unless we turn this around. U.S. Gulf Coast refineries, they are operating on overdrive. They're torn between U.S. domestic production, the west coast of the U.S., which is traditionally long jet fuel, and Europe trying to supply some incremental demand in Europe. But the problem for the U.S. Gulf Coast refineries is that there's already a very small band or margin between what they currently produce and what demand is at. So it's going to be interesting to see. But all of this, of course, acting to drive up prices further.
And what about Canada? Could we see our airlines here affected?
I think we're in pretty good shape, but this is, again, note for viewers, all of our oil for the West really comes from Canadian oil sources, Canadian oil sands sources, conventional oil and heavy oil. East Coast, we've traditionally imported more from, or we've imported from offshore. Today, though, only about 10% of our oil on the East Coast comes from the Gulf, a lot more of it coming from Nigeria, coming from the U.S. Gulf area. So I think we're pretty good. I've got no concerns at this point, but the longer, of course, this drags out, the tougher things might be. But at this point, we've got the refinery capacity to produce our domestic jet fuel. Only one other side comment is people say, well, let's just build more refineries and we'll be great in this country. It'll drive down prices. The latter ignores the fact that the energy prices are set on global markets. The former begs to differ with the fact we've lost 4 refineries over the last 15 years, in Canada. So you just can't build a refinery overnight. But for the time being, the refineries we have in St. John, New Brunswick, in Ontario, in Western Canada are enough to satisfy our jet fuel requirements.
All right. And with it's not just the jet fuel, but it's also the facilities that are building it down, also in the Middle East, refining it down in the Middle East. How much of a concern about damage there? What kind of an impact could that have? That'd be a long-term thing, I imagine.
Well, again, correct. And although we get our own distillates here in Canada, we don't import any jet fuel from the Gulf. I think the point you're trying to make as well with the destruction we've seen of storage and production infrastructure across the various Gulf countries, that does not get produced or replaced overnight. And that's why oil traders are talking about, if we're at $115 a barrel, whatever it is right now. By the way, the crack spreads, the refinery margin on jet fuel this year, according to the U.S. Energy Information Administration, we're supposed to be about $26. Friday, I saw crack spreads in the $75 range. Yesterday, wow. I was looking at cargoes of jet fuel, $1,900 per metric ton, which translates into a crack spread of over $200. So I think the oil traders, when they talk about seeing oil prices even going higher into the 150 plus level, I believe that. And I think if, once things settle down, assuming they will, I think we're going to see crude oil prices still looking at futures into 2027. The strips I'm looking at, we're seeing mid-70s to mid-80s on a systemic basis. So don't expect to see oil back to $55 or $60 anytime soon. And that is reflecting directly into jet fuel prices and into passenger ticket prices. And
I just want, we're almost out of time. I just wanted to ask quickly, cargo jets, what kind of an impact? I mean, would they have priority, or does air passenger have priority? Who might pay the price more?
Yeah, I mean, airlines around the world, they contract with fuel suppliers. That's something we do to secure their own jet fuel supplies, and that will be the case. I mean, you will get individual airlines, whether it's cargo or passenger, commingling jet fuel at airport storage tanks. But I guess the question is, if things get super critical in, let's say, a month and a half or 2 months, could you potentially see a large carrier like a WestJet or an Air Canada potentially take precedence over who gets the next gallon or liter of jet fuel from the tank? So interesting times, but I think we're good in this country. Again, the concern is some select countries in Africa, Europe, and Oceania where things are very, very tight at the moment.
Okay, we have to wrap it up there, Robert, but thanks very much for joining us.
You're welcome.
Robert Kokonis is president and managing director of AirTrav. Up next, a wave of massive IPOs may be coming this way, but history suggests public market investors should temper their enthusiasm. That's next. Some of the world's most valuable private companies, including SpaceX, OpenAI, and Anthropic, are expected to headline a new wave of mega IPOs over the next year. History shows most of the gains often come early, leaving public investors with more risk than reward. For more on this, let's bring in Bloomberg opinion columnist Jonathan Levin. And Jonathan, thanks very much for joining us.
Good to be here. Thanks for the opportunity.
Why is this year shaping up almost, can we call it the year of the IPO?
Yeah, I guess so. I mean, SpaceX is out with some details on its forthcoming offering. Bloomberg is reporting that it could be valued at more than $2 trillion. And of course, everybody is expecting OpenAI and Anthropic to come next. in a way, it's a huge moment in this AI revolution. Everybody's been waiting for a long time to get the opportunity to invest in these companies, but there's this risk here, as in previous mega IPO periods, that the hype has already gotten ahead of these companies, and by the time they finally come to market, there's just not going to be anything left for everyday investors like you and I, basically everybody except the institutional guys, to make any profits off of these things.
But that's not always a bad thing, though, is it? When it comes to when it comes to an IPO.
Well, it depends on the perspective. I guess from the perspective of the founders, they want to price these things tightly. They don't want to leave too much on the table. But if you're if you're an investment banker, you want to maintain those relationships with the buy side. You want to leave something there for the people who are going to invest in these things. So, generally speaking, the sweet spot is one in which the founders and early investors feel like they haven't left too much on the table, but investors, both investors in the IPO themselves and the early buyers of the thing, they want to feel like they're getting fairly compensated for going along for the ride.
Now, is there a danger for the companies if all these IPOs come out at about the same time, these mega IPOs especially?
It's certainly possible that it could have some sort of effect on the market if they sort of slurp up all this risk capital and there isn't much left to go around, so to speak. But I would worry more about what it says about the market. I can't claim to have any privileged information about what's actually going on in these boardrooms, but I think oftentimes what happens in this world in which private capital is so abundant is that founders don't really want to go public until they absolutely have to, until their investment bankers are calling them up and saying, guys, like the window is about to close. If we're going to do this, we need to do it right now. And so in that sense, these spurts of massive IPOs can, on occasion, be sort of contrarian indicators that maybe the bull market is getting a little long in the tooth.
All right, we got to wrap it up there, Jonathan, but thanks very much for joining us. Bloomberg opinion columnist Jonathan Levin. An historic day for a mission truly out of this world. 4 astronauts have gone where no human has ever gone before. The Artemis II crew completing their lunar flyby, observing the far side of the moon. The crew captured endless photos and videos, but it was their description and first-hand account of what they were seeing that left scientists and pretty much all of us so intrigued. CTV's Heather Butts has more.
From the cabin of Integrity here.
A monumental moment for deep space exploration, marked with some poignant words by Canadian astronaut Jeremy Hansen.
As we surpass the furthest distance humans have ever traveled from planet Earth, we do so in honoring the extraordinary efforts and feats of our predecessors in human space exploration.
An historic milestone, the farthest humans have ever traveled from Earth. 4 astronauts on board the Orion space capsule, breaking the distance record set by Apollo 13 more than 50 years ago.
Today, for all humanity, you're pushing beyond that frontier.
Mission Control even sending a pre-recorded message from the late Apollo 13 commander Jim Lovell.
Welcome to my old neighborhood.
Canada's astronaut welcoming others to beat this record.
Importantly, choose this moment to challenge this generation and the next to make sure this record is not long-lived.
Then another milestone, as the crew proposed naming 2 newly identified craters, Integrity after their spacecraft, and a second to honor a member of their space family, Mission Commander Reed Weissman's late wife.
It's a bright spot on the moon. And we would like to call it Carol, and you spell that C-A-R-R-O-L-L.
The crew members embracing one another during an emotional moment in space. For several hours, their lunar flyby was under constant observation, with scientists on the ground watching and listening intently.
A deep hole, and then there's like two island rays pointing off.
My gosh, that was an amazing picture you just painted.
For billions of years, we have only seen one side of the moon as it orbits the Earth, much like two people circling one another, always keeping eye contact.
I don't know if Catherine and Devin are still there, but if they are, just wanted to just let them know how much fun we're having out here. It's extraordinary to be on the far side of the moon right now, just see it hanging out there and looking back at the Earth. And Ashley and Caitlin, I know you're back in Canada, but if you happen to be watching too, just wanted to say hi to all you guys. Love you guys, and we'll be heading back your way shortly.
That powerful message came just before the crew experienced a planned 40-minute blackout in communication with home base as they circled the moon. The capsule now en route back to Earth, which will take several days, with a scheduled splashdown on Friday.
And that was CTV's Heather Butts. Well, Know Your Options is back. Tune in tomorrow at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. And Market Call is coming up next. Today on the show, we have Colin Chazinski. He is Portfolio Manager and Chief Market Strategist at SIA Wealth Management. We'll be taking your questions on technical analysis. And a quick look at the markets before we go. Everybody's struggling to figure out what's next in Iran, and it's showing in the markets right now. TSX off by 0.36, the S&P 500 by 0.81, and the NASDAQ off by 1.1. And that is it for Morning Markets. I'm Roger Peterson. Thank you very much for joining us. We'll see you back here tomorrow.